After the failure of Silicon Valley Bank, the U.S. Treasury Secretary Janet Yellen called for a secret meeting with top bank executives. In that meeting, it was agreed that a rescue package be created to help First Republic Bank survive its crisis. In the end, 11 banks contributed $30 billion to save First Republic Bank, but we all know how it ended. The bank eventually collapsed, and this became the second largest bank failure in United States history. What makes this story more interesting is the fact that a lot of lies were told just to hide the reality from the public. Now they're saying we have nothing to worry about. Can we trust the government? Can we trust the banks? Is this the end of the banking crisis, or is it just the beginning of a bigger crisis? Hit that subscribe button and let's get to digging up the truth about the banking crisis. In 2008, 25 banks failed, and these banks included banks that were considered too big to fail. This was the beginning of what would eventually be a great financial crisis that not only raised financial institutions in the United States, but all over the world. The memories of those times still haunt the banking sector, and some experts think we may see a replay. The Federal Deposit Insurance Corporation, FDIC, is assuring the public that there is no cause for panic. According to the government agency, everything is under control. But how true is this? Remember that by 2009, the banking crises became worse as that year alone, another 140 banks would fail. Right now, it seems we're seeing a replay of similar events. Banks are not just failing, massive banks are collapsing. The fall of Silicon Valley Bank in March of this year was just the beginning of a downward spiral that would soon become a full-blown crisis in the banking sector. With $167 billion in assets and $119 billion in deposits, the bank's collapse was a shock to the nation, and it became the second largest bank in U.S. history to fail. But that was just the tip of the iceberg. This record would soon be surpassed within a few weeks, but no one seemed to see it coming. As if on cue, the FDIC would step in and take over SVB, and that same day took over Signature Bank too. Signature Bank was the 29th largest bank in the country at the time, with $100 billion in assets and $89 billion in deposits. Signature Bank was also on the brink of collapse due to massive withdrawals by panicked customers. The collapse of Signature Bank was blamed on SVB. It was believed that customers of the bank panicked because of what happened to SVB. But the real shocker came when First Republic Bank went down in April, just a month after the fall of SVB and Signature Bank. The bank said they had lost about 40% of all their deposits, amounting to about $100 billion at the time. All these were lost within a month. With a whopping $229 billion in assets and $104 billion in deposits, it became the second largest bank to collapse in U.S. banking history and eclipsed the record of Silicon Valley Bank. And let's not even talk about the shares of the bank. It was simply in shambles. The share price of First Republic Bank had reached an all-time low of 31 cents at the making of this video. This was a share that was valued at about $156 just in May of 2022. The recent bank failures of Silicon Valley Bank, Signature Bank, and First Republic Bank have left many wondering what went wrong. While the FDIC claims that poor management is to blame, a closer examination reveals a more complicated story. A lot is going on here, and everything points to a much larger disaster in the nearest future. For one, the economy is not doing so well. The United States is battling inflation, and the Federal Reserve is going the Paul Volcker way, using high interest rates to try and bring inflation under control. The downside to this is it could lead the economy into a recession. And of course, if the economy enters a recession, banks will have a hard time managing as businesses would struggle and the workforce would suffer some constrictive. But it seems recession came early for the banks because while employment remains strong, businesses are pulling out more funds than they normally would. Even banks like First Republic Bank had planned to cut down their workforce in an attempt to downsize and cut their expenditure. The plan was to reduce their workforce by 20 to 25% and even reduce their office space too. Interest rates have continued to go up as the Fed just announced another 25 basis points increment yet again, taking the current Fed rates to 5.25%. This makes it the highest point interest rates have been in the last 16 years. Another issue is the type of clients these banks have. In the case of SVB, most of its customers were startups and VCs in the Silicon Valley area. So, with the economy pressing hard on investors who cannot afford the interest rates of obtaining credits, they have to ditch some of their investment plans. But the case of First Republic Bank is even more interesting. The bank primarily served wealthy clients, with most of their deposits being above the $250,000 insured limit of the FDIC. What this means is, if anything goes wrong with the banks, only deposits that are $250,000 or less would be remitted to the customers. Any amount above this limit would be lost. If you've been paying attention, you see the problem with this. It means depositors who have more than the $250,000 limit have to be extra careful so they don't lose their money. So, when these depositors get the slightest inclination that something's wrong with the bank, they panic. We saw this happen when Silicon Valley Bank failed. The bank run was triggered by a tweet by Bill Ackman. It is important to note that Bill Ackman's tweet was not entirely accurate and caused unnecessary panic. SVB did not pay depositors only 50% of what they had saved with the bank, but rather sold some of its bonds at a loss to provide liquidity for its customers. The bank also did not experience additional bank runs the following Monday, as predicted by Ackman. However, his tweet did contribute to the panic and led to a significant amount of customer withdrawals. In the case of First Republic Bank, the bank run came after a press conference in which the bank had reported that it had already lost 40% of its depositors. These depositors had left the bank because of SVB's situation. They had predicted that First Republic Bank was also likely to fail. So we knew quite early that the bank was likely to go down under, but the banking regulators and bank executives kept denying the fact. A mind-blowing 68% of deposits in First Republic Bank were uninsured because they were over the FDIC insured limits of $250,000. So it's no surprise that over $100 billion was withdrawn from the bank so quickly. In the case of SVB, selling off unprofitable investments was a necessary step to provide liquidity for its customers, but it also caused losses and eroded investor confidence. However, the bank's management may have been more transparent and open about its actions, which could have helped to mitigate the impact on its stock price. All of these factors have contributed to a delicate banking situation, making it clear that the banking sector is still very volatile. Wealthy depositors who hold a significant portion of uninsured deposits have the power to crash banks, while unprofitable investments are causing banks to lose money. In all this turmoil, there's one winner. That winner is JP Morgan Chase. JP Morgan's latest move in the banking industry has caused quite a stir. The acquisition of First Republic Bank has added a massive $92 billion in deposits and $203 billion in loans and other securities to JP Morgan's already impressive balance sheet. However, it's not just the sheer size of this acquisition that has people talking. It's also the strategic nature of the move. JP Morgan's executives have been vocal about their interest in First Republic's wealth management business, which they believe will help accelerate their own wealth strategy. The addition of First Republic's 84 branches, which have now opened as branches of JP Morgan, is seen as prime opportunity to expand into attractive locations in affluent markets. Certain branches will be converted into JP Morgan's wealth centers, allowing the bank to cater to high net worth clients in a way that it hasn't before. The acquisition was made possible by exceptions to U.S. rules that normally forbid banks as large as JP Morgan from buying competitors. These exceptions are aimed at preventing a larger than necessary hit to the FDIC, and the agency estimated that the cost to its deposit insurance fund will be about $13 billion. This is significantly less than the $20 billion hit inflicted by Silicon Valley Bank's collapse in March, indicating that JP Morgan's acquisition of First Republic was a smart move. JP Morgan's CEO Jamie Dimon believes that the crisis in the banking industry is over and that the American banking system is sound. There are lots of reasons to be worried that a bank like JP Morgan is allowed to grow even bigger. We're talking about banks being too big to fail, and yet a bank like JP Morgan is allowed to grow even bigger, meaning JP Morgan can single-handedly bring down the entire banking sector if anything should go wrong. This should be very troubling. One thing is sure, we have not seen the end of the banking crisis as they would like us to believe. Subscribe to this channel as we will be following updates on the banking crisis, and remember to give this video a like. See you next time.